Okay, well let's get kicked off. Obviously, we're at around about 4:15 in New York and 4:15 a.m. in Perth, Western Australia. So welcome from a very wet winter here, and it's a testament to how much I enjoy doing what I'm doing that the guys at MTI said, "Mike, can you speak at 4 a.m.?" And I said, "Yes, of course." It's always a pleasure and a privilege to share some of my experiences with other traders, because of course we're all traders here, both the guys that are here and speak, and obviously I trade as well. So thank you very much for investing some of your time today to come along. Just a couple of things before we start. Firstly, this is your webinar, it's not mine, and so what I want you to do is ask as many questions as you can, as you want, to get some answers that's going to add something to your trading. As the previous awesome speaker said, look, you're here essentially for free. It's costing you nothing, but education is probably the most valuable investment you can make in any share market or financial instrument. So my job today really is to walk you through really 20 years of experience, and not only from my own experiences, but also those many students that I've coached on a one-on-one basis, as well as all those that I've talked to in this sort of forum, and just give you the benefit of what I see the differences between those who are successful options traders and those who wish they were. It's really that sort of simple. I've got a couple of comments there. I'm a little faint. I'll try and speak up a little bit. How's that, guys? Just let me know that that's working okay. Perfect, thank you. So really the title is 4 Steps to Options Lifestyle Trading Mastery, and I'll talk about what lifestyle trading is as we go through the session. And I've got 2 things that I really want to focus on today that I think will add to your game. But to start things off, let's just give you a little bit a background. I mean, first of all is, look, the reality is that the majority of traders don't really make much money. But if that's you, it's okay. But also, most people who trade know that it's possible. They know that it's possible from listening to any of the speakers today, but also know that it's possible because they can see the potential in the market. So my aim for today is to give you something perhaps that will turn your possible into a reality, and start to see you getting the sustained results that mean you can really make a difference to lifestyle with your trading. Just a little bit about me. Thank you for the great introduction. I really appreciate that. It's very flattering and makes me feel quite humble and blessed to be here. But 20 years a trader, and 10 years of that I've been doing what I do now, really, is as a consultant, a coach and teacher. At this stage I'm working with an organization called Hawkeye Traders, who many of you will be familiar with, and I've been there for about 3 years after meeting the founder, Nigel Hawkes, at a presentation I was doing at the Australian Technical Analysis Association. Tried out Hawkeye software, which is a plugin for which uses something called volume spread analysis, which is another topic for another day. Liked it, and then Nigel invited me to come along and run the options arm of what Hawkeye do. Hawkeye is usable across all financial instruments, but they wanted someone who really was passionate about options trading, so he grabbed me, and we worked together from there. So one of my jobs is to run the Hawkeye Options Trade Alert Portfolio Service, which is running at around about 110% since for the last 12 months. And as has been stated, I'm originally from the UK, now I live in Australia. I'm passionate about seeing other people get results. That's what I do this for. And really that's the key for a lot of these speakers today, is that they're really excited about the potential for sharing something that's really going to make a difference to people's lives. It's really, as a teacher, that's what gives me the kick. So thank you once again for rocking up today. It'd be great to know a little bit about you. We are talking options, so it would be really useful if you could just type in where you are at the moment with your options experience. There may be some of you that are new, some of you that have some knowledge, but have recognized that perhaps you need some more options knowledge to feel comfortable about trading options, and there may be some of you are experienced. So if you wouldn't mind just typing in to the question box where you're at right now, because that'll give me some information about where to pitch various parts of the presentation that we're going to meander through over the next little while. And anywhere is good. Thanks, Paul. Cheers, Amy. Cheers, Daniel. Thanks, Brian. Okay, so we've got quite a mixed audience. Quite a few beginners and quite a few have tested the water with options, which is great. So what I'll do is I'll try and explain things at that sort of level. There is some stuff on here that for advanced traders. So just something for you guys who are newer. It's okay if you don't get it first time. First of all, the recording is available. And secondly, that's what we're here for. We're here to walk you through, here to walk you through whichever level you are, what you have to do to take it to the next level. So really what we're going to cover today is there's a couple of things I'm going to focus on most of my energy on, and that's really the #1 trading business system for options and why this is absolutely crucial for your sustainable success. Now, there is applicability to other financial instruments, so if you're not trading options at the moment, or if you're just new to the game, then I'll try and make reference to how you might apply in your particular situation right now, so you've got something that's actionable. Around what we call a trading business blueprint. We all want to treat trading, or we all should be treating our trading as a business. It's not a hobby. It's not something you're just playing with. It's something that you're making a business decision to get involved in. So we want to do that. And when we talk a lifestyle approach, we're not talking about spending hours and hours a day slaving over a hot PC. We're talking about something that adds to your lifestyle, not takes away from it. So most traders that I've dealt with spend really no more than an hour a day tops, and then can enjoy the rest of the day doing whatever they want with those that they care about. And so that's what we mean by a lifestyle approach. It's not about hours and hours and hours trading over the markets. I'm also going to give you something that I think will be new for most of you, even those of you who are experienced option traders. In my #1 strategy, which I'm calling the no money down setter, and I'll explain what I mean by that. But let's start with this thing called a professional trading business blueprint. And what I mean by that is, and several of the speakers that you're going to hear today, or have heard today, have talked around this. And what we need to do, or what you need to do, is move away from, firstly, from this unbalanced focus on entry indicators. Certainly with new traders, what we tend to see is very, very much this focus on what happens at entry. So what indicators do you use to get in? What indicators do you use to enter a particular trade is what it's all about. So lots of bells and whistles and dots and lines and etc., etc. And really, the only purpose of entry, and write this down, the only purpose of entry is to give you a higher probability of a trade going in your direction. Really, the bottom line is, and we look at successful traders for this, and again, it's a message that you hear from all of the guys, it's what happens next that usually determines your profit loss. So really, there should be as much focus and as much energy and as much effort, sexy though entry indicators are, on what you do after you're in a trade as there is about getting into a trade. So that's the first thing. We're moving away from that with this trading business blueprint. Second thing we're moving away for is what I will call strategy and system skipping. What we see quite regularly is people moving from strategy to strategy, from financial instrument to financial instrument, without really grabbing the learning that's there to enable them to be successful. And by system skipping, we mean we move from one person's system to another's, to another's, to another's, without really properly testing them. And this is absolutely crucial. looking at in a coaching context, one of the primary reasons that I see for people skipping to another system is that they haven't got the results that they thought they might get with the system. However, on closer examination, what we really see is they aren't actually following the system. So they may follow some of the system entry indicators, usually what they follow because that's where their energy and effort is. But it's really, you can't criticize a system. You can't say a system doesn't work until you're trading it to the letter. Does that make sense? So that's absolutely crucial. And one of the things I want you to take away from today, whatever you're trading, is look at whether you're actually trading a trading plan from start to finish. Only then can you make a decision on whether a system works or not. A scattergun approach to trading is the other thing we commonly see. We need to move away from that. It's not just about trading anything that moves. We need to have a considered decision-making process that takes us to the point of deciding not just what we're trading, but what strategy we're potentially using. We can't use the force or some of the supernatural power, as many people do, to make trading decisions. It's got to be considered, and it's got to be system orientated. And it's not just about the enjoyment of trading. And I know, look, many of you will really, really enjoy the challenge of trading against the market, and there's something quite enjoyable about that challenge. But you need to move beyond that. We need to move away from that to making sure that what you do is profitable on a consistent basis. It may also not be a lazy, easy way to make money without you doing any work or learning, and certainly the previous presenter rammed this home towards the back end of his presentation, which I was fortunate enough to hear. If you don't do work and if you don't do learning, you are not going to become the trader you can be through osmosis. Okay? It may not be sexy and exciting. It is a business. And really this, you can be a trader, you can be a trader, you can be a trader, and you don't have to do any work. There's an easy way to do this. Here's 7 easy steps to make money in the share market, or here's 10 golden rules that are going to guarantee a proven method to make money out of Forex. You'll hear that time and time again, and professional traders love that stuff because they would rather you were on the other side of success so they can make the money. So really, what we're about is creating a blueprint that moves away from all of that and yet still involves using leading indicators for high probability entry, and I've already made reference to VSA we use, an equal focus on exits. Make sure you've got those absolutely nailed. Use a range of option strategies to meet your trading goals. So all of those things are still absolutely crucial. And what this does, this trading business blueprint, is it enables you not to know just what to trade, but when and how to trade it, and has a set of measurements in place so you know with certainty and with confidence that what you're trading, the system that you're actually trading, is one that will serve you well. Once you're in that state of confidence, and you'll hear this from every single speaker today, you'll hear that sort of air of confidence about them and how they're trading. And there was a question about fear in the previous presentation. Once you move beyond that, and the answer was that you overcome fear by trading, but you also overcome fear by trading successfully. Okay? Once you've got some results on the board and that you know what you're doing is likely to produce results going forward, there is something about having that air of confidence which enables you to be disciplined and stick to your system. So the only way you can gain that confidence is to measure what you're doing in your trading and whether it works or not. If it does, great, that builds confidence. If it doesn't, move on, try something else until you find your particular groove with trading. So you've got the choice really, and what this professional trading business blueprint is all about is you can continue to trade against professional traders, as many of you will be now, or you could become one of them. I'm guessing the choice of doing the latter is probably more appealing. So today on this session, what I'm going to do is give you two massive steps towards getting where you can be as a trader from this professional trading business blueprint. So first of all, we're going to start off by looking at the number one trading business systems for options traders that is absolutely essential. It's crucial. It's not optional at all. It's absolutely critical to your sustainable success. And here's the problem. Many traders are one-trick ponies, or at best two, meaning what they do is they learn one strategy and they trade it ad infinitum. So it may be credit spreads, it may be covered calls, it may be just simply directional trading, buying calls and buying puts. Whatever it is, they learn that and they stick with that and trade that whatever the market is doing. This does not work. It's not enough, okay? And neither is it taking advantage of one of the huge benefits of trading options, which is the ability to trade multiple markets. So if you've heard anybody say credit spreads is the way to go, that's the only way to go, then that is not true. Of course, there are certain times when credit spreads are fantastic to trade, and we're going to talk about that in a little while. But generally speaking, you would need an arsenal or a golf bag full of trading clubs with 5 or 6 different clubs in there, so you can choose the right strategy for the right market. And of course, one of those choices is not to trade at all. Okay, so it never works. And most trading robots that many of you may have taken advantage of this trading robot or black book system, and you'll have seen accounts blown up, that they can have long periods of profitability, but then end up being a mechanical mess of despair and disappointment simply because there is not one strategy for all market conditions. So the number one trading business system for option traders is matching strategy to market. Okay, so you have this range of strategies. Which one do I choose now to match the market that I see in front of me? So this is the first thing that you should look at before you look at any stock charts. For 2 reasons. First of all, to determine whether your current open positions match the market, and secondly, to determine what new strategies you can take on board. So you're really harnessing the power of this particular financial instrument, making use of multiple strategies. You're harnessing the power of underlying market sentiment with more confidence in making sure that you are choosing a strategy which may give you a higher probability of profit. But also with that, this is about managing risk. You manage risk, you optimize the chance of profit. That's what it's all about being a trader. It's really as simple as that. So you're making a considered business decision at the first point, as the first thing you do in a day, as to where the market is now and what that means to you and your options trading. It doesn't have to be complicated, it can be simple. So let's use, as an example, the direction of a bought call. So what most traders do is dive straight into specific stock charts to look for a buy signal, and obviously subsequently then may do a couple of other checks in terms of ex-dividend dates or whether earnings are coming up, and then bosh, we're in. Okay? But let's just take a step back and make the decision as to whether a bought call is the right sort of trade for this market. Okay, and we can do this quite simply looking at the S&P 500 and the VIX. As I said, we want to keep it relatively simple. So when we do this, and when we look at other strategies, we're asking, is this a strategy that could work for us in this market? And secondly, do we position size normally or reduce the number of contracts we're entering? And position sizing is the number 2 major strategy that you need to master with options to give yourself sustained success. So we're aiming to answer those 2 questions before we look at specific stock charts. So here's an example of a specific system. So if we look at the S&P 500, we can look at the daily chart, a weekly chart, and the daily VIX. That's all we're looking at.
Mike, are you there? It seems we've lost audio. We cannot hear you.
Type yes in the question box, let me know we're back.
Oh, yeah, looks like you're good to go again.
Sorry, I'm not sure what happened there. We've got a couple of storms going on, so maybe we're getting upset from that. Okay, so so we look at the daily S&P 500 and the weekly S&P 500 and the VIX to make this decision. For an uptrend on the daily, we can switch bought calls on with normal position sizing. If we're in neutral on the daily, but still an uptrend on the weekly, then with downtrend or neutral on the daily VIX, then we can still trade bought calls, but we'll do it at a reduced position size. If we're in downtrend on the S&P 500, then, or downtrend on the weekly, then we tend to switch bought calls off as a strategy and look to other strategies. We can also add an extra layer of sophistication into it. Is a very simple system by looking at potential resistance on the S&P 500, and we can add a couple of extra rules as well. Once we've made the decision as to whether we're trading bought calls or can trade bought calls or not, and whether we're position sizing normally or reduced, then we start to look at stock charts that might be a fit. Just that makes some sort of sense. And apologies for the slight interruption there. Now, with credit spreads, I know a lot of you will have been exposed to credit spreads. Just for those of you who are less familiar, what we're aiming to do is scalp some premium by putting the options legs away from the current market action. So let's say a stock was trading at $30. We may place a credit spread at $29.28 with the hope that that doesn't get anywhere near that. The options legs expire worthless and we keep the premium we bought in. So it's a net credit situation, hence the name. We're still trading with the market, and the ideal market conditions is when volatility is relatively high but dropping. We're looking short term. Several previous one goes wrong. Example for the ball usable spread. So see the daily on neutral and daily VIX. We're not using the weekly 500 for this, simply because we're looking at it short term. So we're more interested in daily S&P 500 than the daily VIX. If the S&P 500 is in uptrend or neutral, the daily VIX is in downtrend or neutral, then we can position size normally. If the S&P 500 is in uptrend or neutral, and the VIX is in neutral and less than 3% off recent pivot high, then we would position size smaller. If the S&P 500 is in downtrend, we don't touch a bull put spread. So what I want you to do, those of you who are already trading, is if you are in a situation where you've got a series of trades, look back using a relatively simple system like this and see what would have happened. And I can almost guarantee you that you would remove many of your losing trades if you applied this system. So it is actionable now. It is really important. And as I said, to me, it's the #1 trading system. It's the thing that I see in traders, in option traders who make regular profit to those who don't. Now, if you're in a Forex situation, I did promise to talk of the vehicles, then come up with a similar sort of system, looking at the bigger picture of currency pairings that you're actually trading. So it may be that you look at a daily Euro USD chart, apply some principles to that, and then make a decision as to whether you should be touching that on an intraday basis or not. It's the same principle. You're trying to determine whether this market is suitable for your style of trading. So let's take an example. So here's the S&P 500 as it was about an hour and a half ago. So you see what we are. We're in neutral. We've had this Brexit drop and recovery, and then obviously we're struggling to hold 2100. We did recover a little bit towards the back end of the market after this was taken, but we are in neutral on this. We are in congestion. We're trading within a range between about 2040 and 2000, apart from this one-day blip we had here. Now, if we look at the S&P 500 weekly, we are still in uptrend on the weekly chart. This is Hawkeye trend, by the way. We've got downtrend, congestion being as I said, we're still relatively high to where we've been, and we are in a downward trajectory. So looking at those things, which have taken us 2 or 3 minutes, what we can ascertain from that, looking back at our system, is that if we are to trade bought calls, we've got a tick on the weekly in the fact that it's an uptrend, but our daily trend
Hey Mike, we lost your sound again. If you're still there, could you just give a quick type something quickly in the chat box to let us know? Thank you.
let me know if I'm back. I'm being told my end that it's been restored.
Yeah, you're back now.
Okay, so let me just reiterate what I've just talked about. So with the daily S&P 500 in uptrend, the daily being in neutral, the weekly being in uptrend, and the VIX in downtrend, in neutral but on a downward direction, we can trade bought calls with a reduced position size, or we can trade bull put spreads. So really, without the interruptions, obviously, that we've had, it should take no more than 2 or 3 minutes at the start of your trading day to make that decision. Okay, so what about if you had a trading system, if you had a blueprint for every strategy, the 8 common strategies we use for options trading, how much power and confidence would that give you at the start of your day for knowing that you're trading the right strategy for the market conditions that you see in front of me? So that's really what we're about doing. We're about building confidence in a system and doing the right things on a consistent basis. So one of the things that I'm going to offer going forward is a session whereby we're going to go through this step by step with every one of the most common option strategies chosen that you can choose, and so you can start to test that and develop the confidence for yourself. But we've given you 2 today to start to have a look at already. Now I'm going to move on to shares no money down. As I said, this is one of the most explosive strategies that I know of. It's just to give you a bit of background, it's some of it's based on synthetic options positions, which some of you may be familiar, very commonly used with hedge funds. And then we've added our bit to it, and it's based on covered calls, using the principles of covered calls to try and generate a regular income. But here's the deal with covered calls. Let's start with that first of all. So let me know if you're trading covered calls, please. Just type in the question box whether covered calls are familiar to you, whether you have traded them, whether you are trading them. Okay, if you're coming through have traded covered calls, okay. So many of you like the idea of trading covered calls, and what we've got is a situation whereby somebody holds some shares for the long term, and then they sell call options over the top of those on a weekly or monthly basis to generate premium. Some also may choose to protect that position with a long-term put. So you've got a protected risk cap on the shares that you have and the ability to either pay for the put or generate income from weekly or monthly calls over the top. Now, a couple of issues with covered calls. Despite the attractiveness of 2 to 4% a month on a regular basis, really it's a bit of a it's not a guaranteed 2 to 4% and may not cover the drop in the share, but more so it's the cost to make a reasonable amount of premium. So if you, for example, had 10 contracts of a $30 stock, you'd have to have $30,000 to invest. Obviously, that's one position. You'd want 3 or 4 positions to make sure that you're spread okay. So you're talking really to make a reasonable, life-changing income on a regular basis. You're really talking 6 figures as a minimum requirement to make covered calls an income-changing strategy. The second thing is that sold call management needs to be absolutely robust. Many people make a complete mess of this, primarily because it's not taught very well. But you need to have the ability and a written system for knowing when to sell a call over the top of your position and when not to. You delay writing, when to alter the position to roll up or roll down, and most don't do this well. So there's those 2 things really. There's the cost and also the sold call management. So what if I could tell you, what if I could show you how to get exactly the same movement, one-for-one movement as the underlying share, and it didn't cost you anything at all? Would that be attractive? And then I'm going to show you how to put in a put protection, and then you can obviously sell calls weekly or monthly over the top. So all we're doing is we're replicating the covered call setup with substituting the shares for a no money down position. So here we go. What do we mean no money down? Right. Well, when we buy a call at the money, so let's say our $30 call option when the stock is trading at $30, we want the underlying to go up, as we would do if we bought shares. The delta on that position, and for those of you less experienced, delta is the amount the option value moves up compared to a 1 cent movement in the underlying share price, is 0.5. So if our position cost us $2 and there was an increase in value of the underlying share by $1, there's a move in the call option by 50 cents. So the position would now be worth $2.50, and we would make 50 cents profit if we chose to close that position down. We could also then sell a put option, and the delta on that, if it was not the money put, would be 0.5. Because we're selling an option, we're bringing in $2 a share. So we're buying a call option, selling a put option, and rather than investing, we're getting premium in. So our $2 a share we paid for the bought call is offset by the $2 we're bringing for the sold call, hence no money down. And because these both have a delta of 0.5, we're getting a one-for-one movement with the underlying share. This is a synthetic share position. If the underlying share then moved $1 upwards, because this delta on the put position is 0.5, we get a move in the put option by 50 cents. So if that put option now is not worth $2, it's worth $1.50. So if we were to buy to close that position, we'd make 50 cents profit on that. So we've got 50 cents from our call position, 50 cents from our put position, so $1 profit. And of course vice versa. If it goes up 1 for 1 with the share, it goes down 1 for 1 with the share. So let's look at silver. This is a couple of days old. I apologize for that. So let's say we were to buy a December position when silver was trading at 18.98, and you'll see there the bid ask on the bought call, which is this side, would cost us about 160, and if we look at the put option side, then we'll see that it's around about 157. We will bring back in. So our net payment for that position, which moves 1 for 1 with the share, is 3 cents. So you've got a choice. You could either invest 3 cents in the idea that SLV is going to go up, or you can invest $18.98. Your choice. Then, of course, we can protect it. So if we protect it by putting a long-term put underneath, we could then, here's our put cost. Let's say 105 we paid for that put. So our position has cost us $1.08 for a protected position that moves 1 for 1 with the underlying share. Or you can spend $18.98, still put the put protection in at the same price, and pay $18.95 more for the position. What that means is, let's say you wanted to enter 20 contracts of this, then we'd be paying $38,000 on the one hand, or we'd be paying $2,000 on the other. Your call, you guys. And that would last us through to December, and of course, come December, we could then see where the underlying is, and we would have either taken advantage of that or not, depending on which way the underlying share went. Then, of course, we've got this idea of selling calls over the top. So if we were to look at an August 19 call and we were to sell let's say a $20 call over the top, we could then bring in 50, let's say 55 income. There's our call section. So remember, this position has cost us the 3 cents for the normally down position, the 105 for this, so it's cost us 108, and we can sell one call which would bring half of that back in, let's say 54 cents. So we're bringing 50-cent income back in, which reduces our risk, but also what this means is we can go again then in September, October, November, and December selling more calls over the top, providing, of course, we manage it well. So that's the concept. I've got some positions I took from the market just before we started to give you some more examples in a moment. A couple of things. Liquidity is an issue to get the desired fill, and there are a couple of different ways we can play this. With either play the long-term hands-off approach, or we can play the mercenary approach. And also we can, as a variation, we can do this on the way down to trade a bear market. So we can do what's called a reverse strategy and essentially mirror going short the stock. And no money down again. I'll answer questions in a minute. Just a quick whiz through the issues with the put. Without the put, you'll have no protection, and you'll have a massive margin requirement due to the sold put. So our standard is to place one strike lower. So with a $1 increment if possible. So a margin of $1. So our risk is the margin plus the cost of the put. But of course, every time we sell a call, we reduce the chance of losing money, even if holding this for the long term. There are occasionally gross differences between the at-the-money bought call and put, and this is often dividend related, or maybe due to the underlying market conditions. We can put in extra protection when there's earnings due as an extra layer of protection, and we can also, if we choose to, put the put higher than the normally down position, meaning there's no margin requirement at all. It will be more expensive, but if that would be your preference, we can do that too. And obviously, for those of you going on and learning some more about this explosive strategy, then that's an option you've got. With the sold call, we are using weekly or monthly, depending on your preference, on market conditions and what's happening with the underlying stock. We can choose to delay right, which we would have done with SLV. We may roll down or roll up to optimize profit or bring in more income. And we've got a couple of extra rules we need to take into account so we don't get exercised early when a stock is going to go ex-dividend. But of course, we've got a trading plan to go with all of these components, which we're going to talk about for those of you moving forward with us. So, just to reiterate, we've got a one-for-one movement with the underlying share, which costs us nothing or near nothing. We're then putting some protection in place to cap a risk, but also to reduce margin. And then we're selling weekly and monthly calls over the top. And for this shares no money down strategy, which we call JAWS, we must know the correct setup, how to manage the risk, and how to manage the sold call. So all of these things are going to be covered on a session which I'm going to offer you an invitation to come along to in a couple of minutes' time. Here's T again from a couple of days ago. So we're looking here at when T was trading at 43.35. So let's do a $43 position. So you'll see there that our call would cost us $1.65. Our put would bring back in $2.40. So that's actually a net credit for holding that position of 75 cents. Our put cost, as you'll see from our $42 put, and remember this is a January series, is around about 190. So our total investment in this position is 125. If we sold then an out of the money call for August 44, then we're bringing 48 cents or 38% just for that one sell. And of course we've got the ability to then subsequently sell September, October, November, December and January to generate more income, providing of course we wouldn't like to take the mercenary approach and just take our 38% and look for the next golden opportunity. So I'm hoping that even if you're starting to get the principle of having this no money down position, which is protected, and then generating monthly calls over the top. How about these if we entered multiple contracts? Now these are as live figures as I could get before I had to come and present to you. So Facebook trading at 115.88, we'd enter an NMD position at 115.110 for January. It would cost us 130 and then an additional $7.40 for the put. So a total investment of $8.70. We can sell a 120 sold call for August for $3.20. That's a 37% return. So 5 contracts will be investing $4,350 and bringing back in $1,600. For GPS, so the gap, we could enter a December position, which would cost us, including the put, which would cost us $2.60 in the share. We get a whopping $1.10 for a 51% return. So 10 contracts of that would be $2,160, bring in $1,100. And then GE at 31.88 would enter a 32.31 position. Total cost invested of $135 a share, bring in 35 cents for our sold call. That would be at $33, which is 27%. Now we're always selling an out of the money sold call, meaning that if it goes up, we obviously get advantage of not just the premium we've brought in, but also the move up in the underlying share. So if we were to buy this lot, if we were to buy the shares and sell cover calls, it would be, let me do a quick sum, so it would be a 52,000 plus 57,000, so around about 109,000 if we were to buy the stock and do this for exactly the same return, exactly the same sold call premium as we're doing here. Okay, so it costs us $109,000. We're investing $7,860 and getting exactly the same return. So almost $3,000. So I trust that's sort of interesting. So what we're going to do is give you an opportunity now, put together a kit which I think will help all of you at whatever level you are, that will help. So first of all, I've got my on-demand, my favorite indicator course, which looks at something called a wide bar, which is probably the most reliable indicator. We've got about an 18-to-2 ratio win-loss on this with credit spreads. There's 2.5 hours on credit spreads, on a little bit about strategy to market, but also weekly options, generally speaking. That's available on demand now. Okay, we've also got the Trading Edge video series, which focuses on the systems you need to have in place to make sure your trading business does a rock and roll, and you've got a successful trading system covering all aspects of your trading, whatever vehicle, and the 6 short trading modules. It's almost like a checklist, almost a blueprint for your trading business. That's immediate and on demand. And then the 2 real powerful sessions that we're going to do live. We've got a No Money Down Next Level, where we're going to reiterate the strategy. We're going to go through it step by step, and you're going to have absolute clarity about how to trade this safely with all of the components that I talked about before. And look, that in itself is a course that we sold for over $400 about 18 months ago. And then I'm going to give you access also to an exclusive professional trading business blueprint strategy session, which looks, again, is live, which also accompanying with that will have handouts that you'll be sent to the 8 most common strategies, looking at how we match strategy to market, what we talked about really early on. So over $400 of value there for only $97 at HawkeyeTraders.com/pro. And really, I put it at a no-brainer price, and I put it at I put so much value in there. And this is real value. This is not sort of things that you won't be able to use. And something that will appeal to every level. Now, the 2 live sessions will be recorded. So what that means is that you can review them as many times as you need to. You'll have consistent access to them if you're investing in this. And of course, not only just for review, but if you can't make the live session itself. And I also commit to being available on email after the events to answer any queries you've got to help you move forward. Anything that you don't get, anything that you don't understand, anything that you need further clarity on, I'll be there for you to make sure that you give you the best chance to properly test, and then ultimately, if it's right for you to trade, what you're going to hear on all of these sessions. So remember, this is what we're talking about. We're talking about a phenomenally powerful opportunity to look at adopting this no money down strategy, which can generate you these sort of returns. And these aren't figures I've made up. These are figures from today's trading session. So they were taken at about 3 p.m. Eastern Standard Time, which meant I had to get up at 3 a.m. for you guys to make sure that you had some real deal figures so you could see the real potential of this. Now remember, it's about not only about this sort of return, but it's about managing risk as well. That's why we're placing the put where it is, and I'm going to talk through how to manage the risks associated with this strategy. Let me be absolutely crystal clear. If you go and try and trade this strategy now without knowing about managing the risks as well as optimizing the profit, then you've got rocks in your head. Okay, so for $97, it's a no-brainer investment to make sure that you've got what you need to look at this properly. Okay, and it will suit. We'll go through everything. We'll go through everything that you need to know, whether you're a beginner or an advanced trader, so you feel confident about what you're doing and why you're doing it. That's the purpose of an education. It's not just to say, here, there you go, trade this, this, and this, and you'll be fine. I haven't done my job as a teacher unless I've made sure that you've got the reason why you're doing things as well as what you do.